So I thought maybe a few of you would say, well, why is a reinsurance broker standing here talking about Solvency II and about the impacts that has on reinsurance? The role of a reinsurance broker has changed dramatically over the last 5 to 10 years. This is some of the things that really you might associate with the traditional role of a reinsurance broker, which was, to put it simply, to structure reinsurance, to place it, to find the right reinsurance markets, and then to administrate thereafter. But our role has changed a lot, and Solvency II has been a major driver in that change. So I just want to share with you some of the additional areas that we now as reinsurance brokers look at. I won't go through all of these now, but just to pick out one or two. Retention management up there in the right-hand corner, that's absolutely crucial these days because it's linked so much to the risk appetite of the insurance company. And understanding how much risk they can retain, therefore, has a knock-on impact on how much they need to reinsure. Or looking at non-modelled perils, which was something we talked about earlier. Previously, there's been a lot of focus on the modelled perils. If we think about Europe, we're talking about windstorm, earthquake, flood, hail. Hail to some extent, at least, until recently. Non-modelled perils are equally important to understand and to be able to quantify. And that's an area where reinsurance brokers are helping by either building models or helping to develop an own view of risk for the particular company that has the challenge from a specific non-modelled peril. Or runoff management is another key issue in our market. Looking at reserve risk, many insurers are looking to get rid of certain types of runoff from their portfolio, and that's something which we're heavily involved with. 2 years ago, we decided that we'd explore the topic of risk appetite in somewhat more depth, and so we initiated a survey amongst a selection of European insurance companies to try to understand a bit more about their view of risk, their risk appetite. We talked, we asked them a number of questions, which then ultimately produced a report which we can share with any of you, and we're actually in the process of doing that again in 2015, so the results will be ready at the end of the summer. But we talked about the rising importance of the risk appetite concept and being able to actually define it as an insurer. Then, of course, how that's actually influencing the reinsurance decisions that are made. The renewal strategy, so when the reinsurance is renewed, looking at actually what are the key objectives that I'm trying to achieve and how can I use my reinsurance to do that, and ultimately how to prepare for the Solvency II framework. Just wanted to share with you a few of the key results from this. It's quite a long report, so this is just a small extract. But looking at these charts from the left to the right, the first one is looking at which performance indicator did companies say was most important for them? And the answer there was combined ratio that they picked, the largest group picked. Not so many looked at return on capital and return on equity as a key performance indicator yet, but we think that that will change over time. Then moving to the middle pie chart, that was which underwriting result is most important to companies. And quite clearly there, half of them were saying it's the average, so the average annual underwriting result, which drives my decision making. After that, there was a variety of 1 in 10, 1 in 20, and other higher return periods that were chosen. And moving to the right, this was which capital measure do companies rate as the most important for their decision making. And that was split fairly evenly. The two leading answers there were between economic capital and regulatory capital, which together made up around two-thirds of the decision making for clients. There were many other metrics here that have been investigated, but this is just a flavour for you of how decision making is becoming more formalised by insurance companies. So Solvency II, as we heard earlier, it is a reality. The regulation is coming. Everybody's preparing for it. Many are quite a long way down the line already in certain parts of Europe, depending on how proactive their regulators are being. It's changed the behaviours of insurance companies, and there is a lot more focus on the issues of capital management and risk appetite, as I mentioned. companies are defining the financial goals that they want to achieve. Companies have always done that, but they haven't necessarily had to link it quite so directly with the regulatory capital requirements that are being imposed upon them. And now it's a question of balance, of how can I achieve what I want to achieve in an ideal world and still stay within the framework of Solvency II. And reinsurance is one of the tools that can be used to optimize the company's capital position. And being able to understand and evaluate the impact of reinsurance is crucial to be able to optimize that particular feature. One of the things that we do with our clients is to help them, as I say here, to find a route through the fog. So how do we actually make sure that the reinsurance that they're buying does actually help them to achieve what they'd ultimately like to? And it's a three-step process. So first of all, defining the risk appetite is crucial, and we do that in a variety of different ways by working, for example, with the C-suite, so those who are actually really driving the company and making the decisions for the company, benchmarking with our survey and with other companies, and trying to understand exactly what the companies want to achieve. Once we've done that, we then look at trying to put together a decision-making framework for the companies, and that is very unique to each individual company. So it's building a dashboard to help them to evaluate their decisions. The scope could be one line of business, it could be a whole company, it could be certain things that the board want to look at within the day-to-day business of that insurer. And it's trying to set out what are the measurables by which we will then evaluate the reinsurance. And here we've taken a few examples of metrics that are chosen by many companies. These are some typical examples. So average ROE, average underwriting result at 1 in 5, 1 in 10, 1 in 200, and the SCR and the BCAR. So once we've set what those metrics are, the third and final step is then to link that to the reinsurance. And we would then model a variety of different reinsurance structures. In this particular example here on the bottom right, we've got 4 different strategies listed. By strategy, I mean it could be proportional reinsurance, it could be non-proportional, it could be a mixture of both. It's ultimately different types of reinsurance being bought, and we would measure how well they actually perform against each of those metrics. And then the traffic light system just shows, obviously, which of those perform best compared to each other. So you could see there in that example there, strategy 3 has got quite a lot of red, so probably wouldn't necessarily be the ideal strategy for the company. That company would probably be more likely to be looking at strategies 1 or 4, which is overall meeting the majority of metrics better. So this is very much the kind of approach that a lot of companies now within the EU are taking in order to try to have a better feel for what exactly their reinsurance is doing for them and how much value is it adding. Here's just one case study very quickly. This was a multi-line bank insurer who was looking to grow their business, but their question was, we need to be sure that we have enough regulatory capital to support this growth. So in this particular example, we I don't know how well you can read this, but we selected a number of metrics which are across here, and then we measured, unbelievably, 21 different types of reinsurance for them, which is higher than average, but it was a particularly special case, and they had lots of ideas they wanted to test. And then we could identify fairly quickly, marked in green, the reinsurance strategies that performed best against those metrics. And the box plot here just shows which of those exceeded the 2 thresholds they had for ROE and SCR. So all of these red dots represent reinsurance structures which performed well against both of their key metrics. If we look at the SCR for non-life companies, the biggest risk components to look at are, under non-life, are premium risk, reserve risk, and cat risk. And those are the areas where companies are focusing most. If we look at the Quiz 5 evidence from a wide group of European insurers, we looked at how that breaks down. We looked at their diversified BSCR, and we saw that more than 50%, this is across average for all the companies looked at, more than 50% of the risk comes from the non-life risk. And when we break that down below in the graph on the bottom right, The largest part of that comes from premium and reserve risk, which on average was 70%. Then we had the cat risk, which was a further 50%. And that's actually diversified by the credit that is given for diversification, which achieves the 100% average. So that just gives you a picture of how the average looks for European cedents. So just looking at the premium and reserve risk, you've got a calculation which is applied to the net premium. So it's a factor which is given to you for premium risk depending on the lines of business you're writing, and for reserve risk depending on the types of reserves that you have in your book, i.e. which lines of business you have your reserves for. And within the cat risk component, you've got the natural cat part, which is a very key component for many companies operating in Europe. There's given scenarios which need to be measured against the company's aggregates, and those scenarios are different for each country. There's also the man-made scenarios, which are a set of defined scenarios that are given for different lines of business. Some forms of reinsurance work well for certain types of risks, and others don't so much in the standard formula. And I'll just give you a very quick run through. If you look at the different types of reinsurance that can be bought, measured, how well they perform in the year one standard formula impact against those 4 key risks: premium risk, reserve risk, nat cat, and man-made. Quota share reinsurance performs well in 3 out of 4. Excess of loss reinsurance doesn't really have much impact on the premium risk, but it's great for nat cat risk and for man-made risk. Retrospective reinsurance, an excellent solution for reserve risk, but relatively unimportant for the nat cat risk and the man-made risk, because the losses will already have happened. And stop loss performs similarly to excess of loss. Again, biggest impact is on nat cat and man-made. So it's very important that when reinsurance managers within companies are looking at what type of reinsurance they buy, that they also take into consideration the impact that this will have on their SCR. It doesn't mean that this should be the only thing they're looking at, of course, but it should be something where they should be linking in with risk management within their companies to make sure that they're aligned. And just to talk about some of the areas of analytical support that many insurance companies look for today, often from their brokers. Beyond those obvious nat cat perils here in Europe that I mentioned, which have been well modelled for many years by a number of different providers, there's the additional perils that traditionally haven't been modelled, but where a view is needed because regulators are asking companies to assess that. And there's a selection there of man-made perils as well. So in many cases, we're building models to respond to that risk, or at least helping companies to develop their own view. So to summarize, to conclude, Solvency II is here, and we're now in the formalization phase. So companies now have to put all of the things which they have been developing internally in terms of their direction. They now have to put those into a risk appetite framework and put it on paper in a documented way. Financial aspiration is still, of course, there. Companies want to become profitable, to stay profitable or become more profitable and to grow, but that has to be done in balance with the regulatory requirements. Understanding what your reinsurance does as an insurer is vital, and it needs to be quantifiable. Opportunities exist and will continue to exist, we believe, to use reinsurance intelligently to help improve your position even further. And finally, this is, of course, a continuous process, and we're in the first year where it's really become concrete. We believe that business acumen, analytics, and regulatory knowledge are what are needed in the future for people to perform well and to satisfy ultimately the regulations that are put in place here in the EU. Thank you.